Hello and welcome to the Mutual Fund Show. I'm Neeraj Shah. Over the next 25 minutes, we'll talk about two aspects of mutual funds. One is, of course, can't take your eyes away from all-time highs. And the second part of the show will be focused on what does a mutual fund investor do if she or he has missed out on the bus thus far. But the first segment is about a very interesting new fund offer that is on, that will be on or is on maybe, from the house of SBI Mutual Fund. And Tanmaya Desai, the fund manager at SBI Mutual Fund, joins in to speak about the Automotive Opportunities Fund that they have come out with. Tanmaya, great having you. Thanks for taking the time out. This is Neeraj here. Good afternoon. Interesting time to come out with a fund or a sectoral fund like this. What's prompted this thought?
Right. So when we think about autos, we truly believe that there is long-term growth potential within the sector, within the theme. And the argument is actually premised on three aspects. One, definitely when we look at the underpenetration as far as the automotive industry is concerned across vehicle categories, it is quite starking in India versus a lot of other economies. And we also truly believe that there is a scope of much higher growth across vehicle categories. That's point one. Second, when we also look at the factor of affordability, we believe that has been improving. And that study we tried to do when we looked at the average disposable income increase and trying to tie it up with the increase in the average selling price of a two-wheeler or for that matter, even a four-wheeler. Clearly, we are seeing affordability improving, resulting into premiumization being a very nice play within the automotive industry. And that's true across vehicle categories as well as amongst the component players or the feature-rich element that a car is providing to you and me. And the third factor is auto, again, forms an integral part of manufacturing. And to kind of also be a proxy to the manufacturing theme, within that auto being one of the fastest growing categories, we believe auto kind of fits in well from our side in terms of a thematic offering where we truly believe in the long-term potential within the space.
Okay. There is a couple of thought processes here, Tanmaya. One about how the sector has truly had a good run since the COVID lows, if you will. At least the index seems to suggest that. And if the commodity cycle is to turn a little bit, because if China indeed reflates a little bit and spends on property and reforms, etc., then what has been a real feather in the cap for autos, which is lower commodity prices, might become the Achilles heel. Now, is that a concern for the near term, or how do you think about it?
No, rightly asked, and if one tries to draw the attention of also the viewers, in 2018 or post 2018, we have surely seen a phase of hyperinflation where there was increase in the insurance cost. There was an increase in cost on account of the change in the emission standards from BS4 to BS6. And subsequently in 2020, also the industry being hit by COVID did have a torrid period where auto as a sector did not do well. Last 2 years in that context, we would believe has been some kind of a catch-up. And to that extent, the sector or the theme has done pretty well over the course of the last 2 years. I would like to draw attention to 2 or 3 data points with regards to where we believe valuations are or why it seems still fine to look at the theme at this point in time. When we look at the representation of auto and the auto ancillary companies within the broader indices, they are still much lower than the previous peak that we saw in 2018. That's point number one. Second, when we do look at the valuations for the sector and compare it with historical averages, be it on an absolute basis or even the premium that the sector or the theme commands versus, say, Nifty, we believe or we find that the premium is almost at around average that we have seen historically over the last 10 to 12 years. The third point is while the theme has done very well over the course of the last 1 year, auto has been in some sense a wealth compounder, and during the listing history of Nifty Auto, which will comprise our benchmark, we have seen it deliver 18% CAGR returns over the course of the last 2 decades. You did have a question with regards to the commodity aspect of it. It has kind of been benefiting in some small manner over the course of the last year. Of course, it's very tough to kind of necessarily predict. In certain baskets, we have seen an increase in the cost of the commodity, but I believe there are so many different pockets, whether it is within OEMs or auto ancillaries or even exports, whereby we believe we want to capture the high growth opportunity that the sector is going to offer, not just for the near term, but more importantly for the long term.
Okay, and now, interesting leaflet, I must say, or interesting data. I mean, the tagline, when you drive, India goes far, Tanmaya, very well thought of. Some very interesting data points about how wiring content in EVs is multiple times what happens in the current threes, or average volume weighted transaction price in India versus what's there. Now, how do you use, so for somebody who's watching you right now and trying to understand how would the house use some of the lower penetrated auto opportunities into this fund, what should she or he expect?
So let me try and elaborate that with probably how we are looking at auto ancillaries as a space, because that's a segment which predominantly will comprise of the small cap or the mid cap opportunities, and hence the growth opportunity is much higher. An auto ancillary company in its own life cycle can be a supplier to a single OEM. They can be suppliers to multiple OEMs within the same vehicle category. They can be suppliers to multiple vehicle categories, for example, a four-wheeler or a two-wheeler. They can be supplier of multiple components to the same OEM or to multiple OEMs, which may have synergy or even outside of that. And finally, we can also look at companies which are investing in technology. Some of them are also technology leaders. And within the same component that they may be supplying, they may add a feature-rich element to it, thereby increasing the content for themselves and also satiating the desire or the pull factor, which is coming through now from a lot of consumers like you and me. So in that context, an auto ancillary can have multiple growth avenues across vehicle categories, across OEMs, across components, as well as across technologies.
Okay, so Tanmaya, how would you characterize this? Because again, just trying to understand, for the discerning mutual fund investor who's got investment in flexi cap funds, let's say for example, and knows what percentage of that fund might be in auto and auto related names, how would this fund be different in its, percentage allocation to auto opportunities versus an average fund might be? I'm not saying you have to be. I'm just asking if you will be.
Right. So when you look at a flexi kind of a category, or in fact, for that matter, any diversified fund versus whatever might be the benchmark that we may have, where auto weight today is in high single digits, one may position themselves depending upon where within the auto cycle one is by a certain percentage points higher than the automotive weight within the broader index. Now, when we are actually coming with a thematic fund like auto, of course, 100% of the investment will go towards auto and auto ancillary related stocks. Of course, we can discuss within that what are the buckets that we are kind of looking at, but it essentially gives an investor to participate in the theme in a holistic manner, especially in a category like autos, where we do see a sizable opportunity for a longer period of time. For example, right, while whatever the universe one may want to pin with regards to, say, the mid cap category or the flexi cap category, even within autos, we have a universe of around 134 stocks, of which probably 20 of them are original equipment manufacturers. The remaining are auto ancillary companies, most of them predominantly being small and mid cap in nature, and also some dealer companies as well as trading companies. So we do have a wide universe to participate in the auto and the auto ancillary theme. A thematic fund essentially allows us to go down the market cap, thereby trying to capitalize on the possible high growth opportunity that a smaller company in size may possibly have. Also keep one thing in mind is that this fund will also permit us to evaluate stocks from a global perspective, thereby investing outside India. And to that extent, up to 35% of the fund can be invested in international stocks. So I don't think there is a dearth with regards to opportunities, and it allows an investor to wholeheartedly participate in a single theme, especially one which we believe is truly structural in nature.
Are you going to be investing that required amount in international stocks, Tanmaya?
Even at a fund house level, we don't have any example where we have gone to that level of 35%.
Got it.
It's just for the interest of our viewers that I mentioned that that's what the fund does permit us to go to. Auto actually is a very global theme, and hence there can be many interesting ideas even sitting out of the country for us to evaluate and invest.
No, and because that's a differentiating factor, right? We don't get to participate in global chip making companies and global EV opportunities because India is still at a nascent stage. So in that sense, that's very interesting too. Tanmaya, what's the kind of, I mean, nothing is fixed, of course, but what kind of return-seeking investor should invest in a thematic fund? Usually people say thematic funds are cyclical and riskier. Auto seems to be a lot more structural than what some of the other themes might be. So I'm just trying to understand, should an investor who's seeking an X percentage of return look at this fund or something different? Can you outline that for us?
Sure. See, by definition, a thematic fund will entail definitely a higher risk capability. And to that extent, somebody who is seeking more risk and as a consequence of that, higher return expectations is an investor who should evaluate a thematic fund. At any given point in time, while we always would educate and advise that there are various categories of funds that should be part of an investor's portfolio, a thematic fund should form only a small percentage of the portfolio for most investors. Now, this truly being in some sense structural in nature, and if one has to truly capitalize on the various cycles within the automotive industry, because again, every vehicle category will have its own cycle to play, then I think the minimum investment horizon that an investor should consider when they evaluate a fund like SBI Automotive Opportunities Fund should be a minimum of 3 to 5 years.
Got it. Well, we wish you all the best for this, Tanmaya. Thanks for taking the time out and being with us and giving us some thoughts around this interesting opportunity.
Thank you. My pleasure.
All right, that's the view from SBI Mutual Fund. If you wanted to know what the Automotive NFO is all about, you got a sense. I would urge you, all viewers, to try and speak to your financial advisor for seeking or understanding the appropriateness of a thematic fund like this in your portfolios. For some, it may be a shoo-in. For some, it may be not. So please do consult your financial advisor before you try and take any decisions on investing into not just this, but any thematic funds. But on the other side of the break, we try and get in somebody who's a market veteran and ask him, because he heads a mutual fund now, about what should people who missed out on the rally thus far do with their investments into the mutual fund space with the markets at record highs. Rajesh Bhatia of ITI AMC joins us.